about to drop the hammer and dispense some indiscriminate justice.
Oh my God, ladies and gentlemen, did you see what happened? The market is flashing a big red dangerous sign. An alarm is going off. The market's about to crash. Now the question is, should you sell? Should you buy bonds? What should you do? Well, Strongman is going to clarify some things for you in this video, and I'm going to tell you why you should always be prepared for long periods of flat or massive underperformance in the stock market. And if you can't handle that, then you shouldn't be freaking investing. Now, recently, over the past, 9, 10, 11 years, stocks have just gone up, been 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 up, except for the quick, virus dip. But if you look back in the past, you'll actually see there are long stretches of time where the S&P 500, which I think you should invest in more than the S&P 500. But for this video, the S&P 500 has been flat for decades. Now, here is why dollar cost averaging and buying total world stock market index funds and tax advantage accounts consistently will help you build massive wealth, even if the stock market's flat for a long time. Now let's go look from left to right on this pretty little image that I downloaded, and we're going to see that there have been some pretty crazy periods where the market has been flat for a long time. So if you look from, I think this began in like the 1929, I think this tip right here is 1929. So as you can see, the market crashed right when the Great Depression started. And then the market recovered, and then it crashed, and then it recovered, and then it crashed. And this basically happened for 25 years. The market finally broke even, it looks like, in like 1952, 1953. So if you had just gone all in at the top here in 1929, for the next 25 years, you wouldn't have made a freaking dime. However, think about it this way. What if you also owned international stocks, which they probably went down too? But there's always periods where international stocks will outperform U.S. stocks, especially if there's a very heavy America-specific crash. Yes, I know they're highly correlated, but still, they're not perfectly correlated. Imagine if you owned international stocks and you were also dollar cost averaging and buying consistently. So think about this drop. So we're in 1929, the stock market crashes. Every couple weeks, you're buying all the way down, 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 down. Every couple weeks, you're contributing to your IRA, you're contributing to your 401k. Then the stock market goes up, and you're buying then as well. But then it crashes again. Oh, but you're still buying. So even though you maybe bought a little bit at this top in 1929, you've still been consistently buying through the market's ups and downs. Now, if you had done that, the stock market would have broken even in 1955, let's say as an example, but you still would have made a ton of money because you basically bought the dips consistently and you got the average cost of the market over the last 25 years. That is why dollar cost averaging, in my opinion, is superior to trying to time the market, because you might think you're a genius and be like, well, it's 1928, I'm just going to go all in. And then you do that, you throw all your money in, and then you get freaking annihilated when the market crashes. And then you sell probably down here at the bottom, and then you probably try to buy in here, and then it crashes here, and then you sell. It's just a freaking disaster. But if you buy consistently, you're buying more and more and more ownership of the S&P 500. Just think of yourself as, or think of your goal in your financial life as acquiring as much ownership of every company in the world as you possibly can. Think about, I own 0.0001% of every company in the world, but by the time I retire, I want to own 0.0008% of every company in the world. And I can live off all the profits and growth of those companies of the world going into the future. That is what you should be thinking about. You need to be prepared for periods like this, where there's a massive crash, and then a recovery, and then a crash, and for even multiple decades of flat returns. Because you're buying shares on the cheap, and eventually, as the economy grows, your stock portfolio will grow with it. But if you're really worried about this in the United States, I mean, look, it happened again. It looks like in maybe it's at the 1970s, and then it took till maybe the 1980s, 1990s for the stock market to really recover. And then we had the dot-com bubble, then we had the Great Recession, and now we're in this massive freaking run-up that we're in right now. But look at that. If you just bought consistently, I mean, look at from 1929 to now. It's up pretty freaking massively. It went from 500 all the way to 4,500. So that's all you need to worry about, okay? If you believe that the world is going to be more prosperous, more technologically advanced, people are going to be more productive in the next 20, 30, 40 years, then go ahead and put as much as you possibly can into your tax advantage accounts and buy total world stock market index funds or index ETFs, because you will grow your wealth, you will own more and more of the world, and you'll be able to live off the productivity and the increasing productivity of the world when you retire. Now, last but not least, a lot of you may be 100% stocks, but if you're worried about crashes and buying the dip, then you should maybe have some kind of short-term bond allocation into your portfolio. Yes, bonds don't make a lot of money, but they're there to give you stability in your portfolio, and they allow you to buy the dips when the market goes down. Because generally bonds will stay flat or go up. They're inversely correlated to stocks. So if you have 20% bonds and 80% total world, if the world stock market goes down, the bond portion of your portfolio will grow as a percentage of your portfolio, and then you can sell out of that and buy those stocks that went down on the low. So be prepared for long periods of underperformance, but just know that in the long run, if you believe the world's going to become more prosperous and more advanced, then you're going to be fine, okay? And you don't have to expose yourself to single country risk. This is just the U.S. stock market. You can own the entire world, which will probably dampen the volatility and the risk that you get totally screwed. That's it for today. Max your tax advantage accounts. Buy total world index funds or ETFs. Don't look at your portfolio. Don't pay Jeremy $20,000. Don't listen to Meet Kevin. Don't listen to StockMo. Just stay the course, and you're going to be just fine. Have a wonderful Sunday.